One text message. That's all it took. A guy in Ohio sold his car for $11,000 in cash. Nothing shady, nothing illegal. 6 months later, he got a letter from the IRS. Not because he did anything wrong, because of how he did it. Right now, you might be making a transaction that's quietly putting your name on an IRS watch list, and you don't even know it. Stick with me. I'm about to show you exactly which ones. Hey, welcome back. If you're new here, I break down taxes, money, and IRS rules in plain English. No confusing jargon, no boring lectures. Just the stuff you actually need to know to protect your money. And today's topic is a big one. Every single year, the IRS flags thousands of people for audits. And here's the crazy part. Most of them never saw it coming. They weren't criminals. They weren't hiding millions in some offshore account. They just made a few common, everyday transactions the wrong way. By the end of this video, you're going to know exactly which transactions raise red flags, why they raise those flags, and, most importantly, how to avoid becoming the IRS's next target. This is one of those videos you really don't want to skip. So before we jump in, do me a quick favor. Hit that subscribe button and tap the like. I'm covering IRS secrets most people never talk about, and you don't want to miss what's coming in this channel. Let's get into it. Let's clear up a myth first. Most people think audits are random, like the IRS spins a wheel, and whoever it lands on gets picked. Some unlucky soul, wrong place, wrong time. That's not how it works. Not even close. The IRS uses a computer system that scores every single tax return. It's called the DIF score, Discriminant Information Function. Basically, it's a formula that looks at your return and compares it to thousands of other returns from people in a similar situation. Same income range, same job type, same deductions. If your return looks different from the normal pattern, too many deductions, income that doesn't match, numbers that seem off, your DIF score goes up. And the higher that score, the more likely a human being at the IRS actually looks at your file. But here's the part most people don't realize. The IRS doesn't just look at your tax return, they get information about you from other places too. Your bank, your employer, payment apps like Venmo and PayPal, even crypto exchanges. This is called third-party reporting. Basically, other companies are required by law to tell the IRS what money moved in and out of your accounts. So when you file your taxes, the IRS is already holding a second copy of your financial story from someone else. And if your story doesn't match their story, that's when the questions start. So audits aren't random, they're triggered. And in the next few minutes, I'm going to walk you through the specific transactions that flip that switch. Let's start with cash, because this is where a lot of good, honest people accidentally get themselves flagged. Here's rule number 1. Anytime a business receives more than $10,000 in cash from one transaction, that business has to file something called Form 8300. This tells the IRS, hey, this much cash came in, here's who it came from. Now this makes sense for big purchases. Buying a car, buying jewelry, paying for something expensive in cash. The business isn't accusing you of anything. They're just following the law. But here's where it gets tricky. Some people hear about this $10,000 rule and think, okay, I'll just break the payment into smaller amounts so it doesn't get reported. That's called structuring, and structuring is illegal, even if the money itself is completely legal. Let me say that again, because it surprises people every time. It doesn't matter if your cash is 100% legitimate. If you deposit it in a way that's designed to avoid the reporting rule, like putting in $9,000 today and another $9,000 tomorrow, that pattern alone can trigger a federal investigation. Banks are trained to watch for this. They call it a Suspicious Activity Report, or SAR, and if your bank flags your account, that report goes straight to the government, sometimes without you ever knowing. Now think about normal everyday situations where this can happen without anyone meaning any harm. Selling a car privately for cash, getting cash gifts for a wedding, running a small business that takes cash payments, a food stand, a salon, a barbershop. None of these are wrong. But if the cash moves in a pattern that looks like structuring, you can end up on the IRS radar for something you didn't even realize was a problem. The lesson here is simple. If you're dealing with large cash amounts, don't try to get clever with how you deposit it. Just deposit it normally, keep your paperwork, and if a business is required to report it, let them report it. Trying to dodge the reporting is what actually gets people in trouble, not the cash itself. Now let's talk about something a lot of us use every single day: Venmo, PayPal, Zelle, Cash App. These apps feel casual, like sending a friend money for pizza, but the IRS has been paying very close attention to them in recent years. If you're receiving payments through these apps for goods or services, even side jobs, even small freelance gigs, Those platforms are now required to report your transactions to the IRS once you hit a certain dollar threshold in a year. This is done through something called a 1099-K form. Here's where people get caught off guard. Let's say you sell furniture on Facebook Marketplace and someone pays you through Venmo, or you do some freelance design work and get paid through PayPal. The platform sends that information straight to the IRS. Now, if you don't report that same income on your tax return, but the IRS already has a form showing you received it, guess what happens? Mismatch, red flag, letter in the mail. Next, let's talk about bank transfers. Sending or receiving unusually large transfers, especially if they're frequent or if the amount jumps way beyond your normal spending pattern, can also raise a flag. Banks monitor this closely, and again, they can file that suspicious activity report if something looks off. And then there's crypto. If you think crypto transactions fly under the radar, that's outdated information. The IRS now asks directly on your tax return whether you received, sold, exchanged, or acquired any digital assets during the year. That question is not optional. You have to answer it. And crypto exchanges are increasingly required to report your activity just like a bank would. Buying and holding crypto isn't usually a problem, but converting it, trading it, or cashing it out without reporting the gains, that's a fast way to trigger a review. Last thing in this section, if you have money sitting in a foreign bank account and the total value goes above $10,000 at any point in the year, you're required to file something called an FBAR, a foreign bank account report. A lot of people don't even know this requirement exists, but not filing it when you're supposed to is one of the more serious triggers out there. The theme in this whole section is simple. Every digital dollar you move leaves a paper trail. The IRS doesn't need to guess anymore. They usually already have the receipt. This next one is probably the single most common reason regular people get audited. It's not fraud. It's not hiding money in a suitcase. It's simply forgetting or not realizing that a number on your tax return needs to match a number the IRS already has. Here's how it works. Your employer sends the IRS a W-2. If you freelance, companies that paid you more than $600 send a 1099-NEC. If you're on gig apps or getting paid through platforms, those companies send a 1099-K. All of these forms go to the IRS directly, not just to you. So when you sit down to file your taxes, the IRS is essentially checking your homework against an answer key they already have. If your return says you made $40,000, but the IRS has forms showing you made $45,000, that $5,000 gap doesn't just disappear. It gets noticed, and it usually results in a letter, sometimes called a CP 2000 notice, asking you to explain the difference. This is where side hustles become a real problem for people. Maybe you drive for a rideshare app on weekends, maybe you sell things online, maybe you do some freelance work on the side of your main job. A lot of people think it's just a little extra cash, it's not a big deal. But if that income was reported to the IRS by the platform you worked with and you don't report it yourself, that's an automatic mismatch. Another sneaky trigger. Rounded numbers. If your entire tax return is full of numbers like exactly 5,000, exactly 2,000, exactly 1,000, over and over, it can look like you're estimating instead of using real records. Real income and real expenses are almost never perfectly round. When everything is suspiciously neat, it can raise a flag simply because it doesn't look like normal, organic financial data. The fix here is honestly pretty simple. Report everything, even the small stuff. Keep your records straight. And if you're not sure whether a certain form was sent to the IRS about you, assume it was. It's always safer to report a little too much than to leave a gap the IRS can spot in about 5 seconds. Now let's talk about deductions, because this is where a lot of well-meaning people accidentally paint a target on their own return. First up, the home office deduction. This one is legitimate. If you genuinely work from home and have a dedicated space used only for work, you can absolutely claim it. But here's the problem. This deduction gets abused a lot, so the IRS pays extra attention to it. If you're claiming a home office but the space isn't used exclusively for work, like it's also your guest room or your kid's playroom, that's a problem waiting to happen. Next, large charitable donations. Giving to charity is great, and it's a legal deduction. But if your donation amount looks unusually high compared to your income, let's say you make $40,000 a year, but you're claiming $12,000 in donations, that ratio looks unusual to the system. It doesn't mean you're lying. It just means the IRS wants proof. And if you don't have receipts or documentation to back it up, that deduction can unravel fast. Then there's the classic, claiming 100% business use of a vehicle. This one is a huge trigger. Very few people use a car exclusively, 100% only for business, with zero personal use whatsoever. When someone claims this, especially without a mileage log to back it up, it looks like an exaggeration rather than an honest deduction. And finally, there's something called the hobby loss rule. This applies to people who run a small business, maybe something like photography, crafting, coaching, consulting, and claim a loss on it year after year after year. If your business shows a loss every single year with no signs of ever making a profit, the IRS may decide it's not really a business at all. Instead, they'll call it a hobby, and hobby losses are not deductible the same way business losses are. The pattern across all of these? Deductions themselves aren't the problem. The problem is claiming deductions that look exaggerated, inconsistent, or undocumented. If you can back up every number with real paperwork, you're in a much safer position than someone who's just estimating and hoping for the best. Let me tell you about someone. I'll call him Mike, not his real name, but a very real situation. Mike ran a small landscaping business. Nothing huge, just him and a couple of guys doing yards around his neighborhood. A lot of his clients paid him in cash. Totally normal for that kind of work. Here's what Mike did wrong, without even realizing it. He'd get paid $200 here, $300 there, sometimes $1,000 for a bigger job. Instead of depositing it regularly, he'd let cash build up at home, then deposit it in chunks under $10,000 whenever he needed money in the bank. He wasn't trying to hide anything. He just didn't want the hassle of extra paperwork from the bank. But to the bank's system, this pattern looked exactly like structuring. Multiple deposits, always conveniently under the reporting threshold, coming from an account tied to a cash-based business. The bank flagged it. A suspicious activity report went out. A few months later, Mike got a letter, not just about that year. The IRS wanted to look at his last 3 years of returns. Because his deposits didn't clearly match the income he reported, they wanted proof of where every dollar came from. Mike hadn't kept great records. He didn't have invoices for every cash job. He didn't track his mileage properly. What should have been a simple, honest small business ended up taking months to sort out, plus penalties for underreported income he genuinely thought he had already accounted for. Here's the thing, Mike didn't do anything criminal. He just made simple, common mistakes. He deposited cash in a pattern that looked suspicious. He didn't keep clean records, and his numbers didn't line up cleanly with what the IRS could see. That's really what this entire video is about. Most audits don't come from criminals. They come from regular people making everyday mistakes with cash, income, and deductions. Mistakes that are completely avoidable once you know what to watch for. So let's bring this all together. Here's how you actually protect yourself. Number 1, keep clean, simple records. Save your receipts, track your income. If you're running any kind of side business, even a small one, write things down as you go instead of trying to remember everything at tax time. Number 2, never structure your deposits. If you have a large amount of cash, just deposit it normally. Trying to break it into smaller pieces to avoid reporting is one of the fastest ways to turn a normal transaction into a federal problem. Number 3, report all your income, even the small stuff. Side gigs, freelance work, cash jobs. If money came in, it needs to show up on your return. Remember, in a lot of cases, the IRS already has a form showing that money moved. Don't leave gaps for them to find. Number 4, if your finances are getting complicated, multiple income streams, crypto, a small business, big deductions, talk to a real tax professional. Paying a couple $100s for good advice is nothing compared to the stress, time, and penalties of an audit. None of this is about being scared of the IRS. It's about being smart. Most people who get audited weren't doing anything illegal. They just didn't understand how these systems work. Now you do. Let's do a quick recap. Large cash deposits, digital payment mismatches, unreported side income, and deductions that don't add up. These are the transactions that quietly put people on the IRS's radar. The good news? Now that you know them, you can avoid every single one of these mistakes. If this video helped you, do me a favor. Drop a comment and tell me your biggest tax question. I read every single one, and I might make a whole video answering it. And if you haven't already, hit subscribe. I'm putting out more videos just like this one. Real tax survival tips in plain, simple language, so you never get blindsided by the IRS again. Share this video with someone you know who deals in cash, runs a side hustle, or has a small business. This information could genuinely save them thousands of dollars and a whole lot of stress. Stay smart with your money. I'll see you in the next one.